It's Monday evening, January 19th, 2026. And what happened in silver markets this morning is something most people won't fully understand until it is far too late. I've spent 12 years analyzing physical commodity flows, the unglamorous work of tracking inventories, monitoring warehouse receipts, mapping supply chains that most traders never see. What unfolded today wasn't speculation. It was structure reaching its breaking point. This morning, silver crossed $94 per ounce, a 205% gain in 14 months. The headlines will call it an explosion. But explosions are events. This was a mechanism, one that had been building pressure since the Federal Reserve's first rate cut in September 2024, accelerating through each subsequent monetary pivot, each tariff announcement, each supply disruption carefully documented by the Silver Institute. Here's what made it different from previous rallies. The infrastructure underneath had changed. Industrial demand for silver and semiconductors, solar panels, and AI server cooling systems had risen 34% year over year. Meanwhile, primary mine supply, already constrained by a decade of underinvestment, was growing at just 1.2% annually. The same metal, different plumbing. And when President Trump announced aggressive tariff threats over Greenland's mineral rights on January 18th, the market didn't just react, it exposed what was already there. A 4.4 billion ounce commercial short position, documented in CFTC commitments of traders reports, facing an annual production of just 800 million ounces. The math was visible to everyone. But math doesn't move markets. Realization does. And the danger wasn't in the price, it was underneath it. If this walk through the mechanics of a late cycle commodity squeeze sharpened how you understand structural tension in markets, take a moment to like this video. It quietly tells the system this work has value. Because what happened to silver in early 2026 wasn't an accident, it was architecture. Picture the global silver market at the start of 2025. Annual production. Approximately 1 billion ounces, split roughly 75% from primary mines and 25% from base metal byproduct. Annual demand, 1.2 billion ounces, with industrial applications consuming nearly 60% of total supply, a structural shift that had been building since 2020. For decades, silver had traded primarily as a monetary metal, its price moving in sympathy with gold, driven by investment flows and safe haven demand. But between 2020 and 2025, something fundamental changed. The energy transition accelerated. Solar panel installations doubled. Electric vehicle production tripled. Data centers proliferated, each one requiring silver-based thermal interface materials for cooling high-performance chips. Silver became infrastructure, and infrastructure doesn't trade like jewelry. At the time, most analysts focused on the gold-silver ratio, the traditional measure of relative value. When silver began 2025 trading at a ratio of 88.1 against gold, it looked historically cheap. And what no one questioned was the structure holding it up. Industrial demand had made silver inelastic. There were no good substitutes for its thermal and electrical conductivity in critical applications, and the mine supply that might respond to higher prices. It takes 7 years to bring a new silver mine online. The flexibility had already been lost. To understand how we arrived at January 2026, you have to go back to September 2024. The Federal Reserve cut interest rates for the first time in 4 years. Not because the economy was collapsing, unemployment stood at 4.2%, GDP growth was positive. The Fed cut because inflation had cooled enough to justify normalization, and because financial conditions had tightened to restrictive levels. It was a perfectly reasonable decision, but monetary policy doesn't just affect the economy, it affects everything priced against the dollar. Within 48 hours of that first rate cut, silver rose 6%, not because of new industrial demand, not because a mine had closed, because the opportunity cost of holding a non-yielding asset had just declined, and because a weaker dollar made dollar-denominated commodities more attractive to foreign buyers. The policy worked exactly as intended, but it also did something else. It changed the calculus for every entity with a short position in silver futures, primarily commercial banks and mining companies hedging future production. These weren't speculators, they were institutions managing real exposure. But as silver began to rise, those short positions began to lose money. And in a rising market, the natural response is to cover, to buy back the contracts and close the exposure. Except there was a problem. The short interest was massive. According to CFTC data from October 2024, commercial traders held net short positions equivalent to nearly 6 months of global production. Covering that position would require buying, and buying would push prices higher, which would trigger more covering. This is called a feedback loop. It worked, but only under conditions that would not last. Between October 2024 and December 2025, silver rose from $30 to $72 per ounce. A 125% gain in 14 months. The fundamentals were real. Industrial demand continued to surge. The IEA reported that solar installations alone consumed 20% more silver in 2025 than in 2024. Mine supply remained constrained. The Silver Institute documented a supply deficit of 184 million ounces for the year. Investors poured money into silver ETFs. Holdings in SLV, the largest physically backed silver fund, grew by 41%. Retail buyers in India and China accumulated coins and bars at record rates. Every price increase validated the narrative. Higher prices attracted more buyers. More buyers pushed prices higher. The cycle reinforced itself. But there was an unintended consequence. As silver rose, the economics of recycling improved. By late 2025, secondary supply from recycled electronics, solar panels, and industrial scrap had increased 18% year over year. That recycled silver entered the market as new supply, helping to balance the deficit, but also introducing a price-sensitive source of metal that would accelerate if prices continued to rise. The faster silver climbed, the more supply it incentivized. Another feedback loop, this one in the opposite direction. And there was a second trade-off. Higher silver prices made hedging more attractive for mining companies. Producers with silver as a byproduct, zinc miners, lead miners, copper miners, began locking in prices by selling forward contracts. Each hedge was rational risk management, but collectively, those hedges added to the short interest that would eventually need to be covered. The stronger the rally became, the more pressure built underneath it. Prices improved. The plumbing tightened. By December 2025, the gold-silver ratio had collapsed to 62.1, the lowest level since 2020. Analysts called it a breakout. What they didn't emphasize was how many participants were now structurally vulnerable to a reversal. The warning signs appeared in November 2025. Silver had 7 separate trading sessions with intraday price swings exceeding 4%. In a single week, the metal moved from $68 to $74, then back to $70, then to $76. This wasn't normal volatility. This was instability. Professional traders recognized it immediately. Widening bid-ask spreads, slippage on large orders, liquidity providers stepping back from the market during periods of stress. The Chicago Mercantile Exchange raised margin requirements for silver futures contracts 3 times in 6 weeks, a clear signal that the exchange itself was concerned about counterparty risk. But prices kept rising, and that was the problem. Pay attention to this part. When a market becomes highly volatile but continues to trend higher, it attracts 2 types of participants: momentum traders chasing returns, and hedgers desperate to reduce exposure. Both groups are buying, but for opposite reasons. The momentum traders want more exposure. The hedgers want to close positions that have moved against them. As long as prices rise, both groups push in the same direction. But the moment the trend breaks, their incentives reverse. Momentum traders sell to protect profits. Hedgers stop buying because their urgency to cover has reduced. The buyers disappear simultaneously. In December, the People's Bank of China announced it would pause gold and silver purchases for the first quarter of 2026, citing portfolio rebalancing needs. It was a routine statement. Central banks adjust their buying patterns regularly. But silver fell 8% in 2 trading sessions. The decline triggered stop-loss orders. Those sales triggered more stop-losses. Within 72 hours, silver had erased 3 weeks of gains. Then it recovered. Within a week, silver was back at new highs. Nothing collapsed. And that was the problem. The volatility hadn't resolved anything. The short interest remained. The structural deficit remained. But now, participants knew the market could reverse violently without warning. Risk awareness had increased, but positioning had not changed. On January 18, 2026, President Trump issued a statement regarding Greenland's strategic mineral resources. The statement referenced tariffs, national security, and critical mineral supply chains. The language was aggressive, but not unprecedented. Similar rhetoric had appeared in previous trade negotiations. Under normal circumstances, it would have generated a brief news cycle and modest market reaction. But silver wasn't in normal circumstances. The commercial short position had grown to 4.4 billion ounces, 5.5 times annual mine production. Industrial buyers, concerned about supply security, had begun building inventory beyond normal levels. Physical demand in Asia had absorbed most available spot supply. The market was structurally tight, and structural tightness means there's no buffer. When Trump's statement hit the wires at 6:42 a.m. Eastern Time, silver futures were trading at $89.50 in pre-market. Within 90 minutes, silver reached $94.88, a $4.58 move, off 5.1% in less time than it takes to commute to work. This wasn't a measured response to new information. This was a liquidity event. Commercial traders with short positions needed to cover immediately. There weren't enough sellers. Prices gapped higher, triggering automated buy orders, which pushed prices higher still. The system was designed for orderly markets, but order requires liquidity on both sides, and liquidity had evaporated. By 9 a.m., trading had stabilized around $93.40. Some profit-taking had emerged. Some physical sellers had stepped in. The circuit breakers hadn't been hit, but they'd been tested. The move made headlines. Analysts called it an explosion. But explosions are disorderly releases of energy. This was the logical endpoint of a mechanism that had been tightening for 16 months. Every hedge that made sense individually had contributed to collective fragility. Every supply deficit had reduced flexibility. Every price increase had attracted participants who would need to exit. From this point on, the outcome was no longer optional. The question wasn't whether the pressure would release. The question was when and how fast. By the close of trading on January 19th, silver had settled at $93.12, a 3.81% daily gain. Year to date, the metal was up 30.9%. Since January 2025, the gain was 205%. Some participants made extraordinary returns. Investors who had purchased physical silver in early 2024 when the metal traded below $23 saw their positions triple. Mining companies with unhedged production exposure generated windfall profits. Long-only commodity funds posted returns that exceeded every other asset class. But for every winner, there was a counterparty. Commercial banks with short silver positions recorded losses measured in billions. The precise figures remain confidential, but regulatory filings from major institutions showed significant unrealized losses in precious metals derivatives during Q4 2025 and Q1 2026. Some of those losses were hedges against physical inventory, temporary accounting losses that would reverse when the physical metal was sold. But some were speculative positions, or structural shorts maintained for liquidity provision, or legacy hedges that had been rolled forward for years. Those entities absorbed real economic losses. The cost wasn't distributed evenly. Retail investors in silver-producing regions, particularly Mexico and Peru, saw local economic booms as mining operations expanded and employment increased. But retail investors who had purchased silver at $90, expecting the rally to continue to $100 or beyond, now held positions near all-time highs with significant downside risk. Industrial consumers, solar manufacturers, electronics producers, automotive suppliers faced input costs that had tripled in 14 months. Some could pass those costs to customers, some could not. The power shift was structural, not emotional. Entities that had held physical metal gained pricing power. Entities that needed physical metal lost negotiating leverage. Entities with flexible supply chains adapted. Entities with fixed contracts suffered. And the recycling industry, dormant for years when silver traded below $25, suddenly became profitable again. Secondary supply operations scaled up. E-waste processors installed new separation equipment. Industrial scrap that had been worthless was now valuable. The market was creating its own relief mechanism, but it would take time. If you value analysis that treats financial history seriously, subscribing simply ensures you don't miss work like this. Because what happened to silver in January 2026 wasn't unique. It was a pattern, one that repeats whenever tightening plumbing meets rising prices. Silver reached $94 per ounce on January 19th, 2026. Whether it goes higher depends on factors no one can predict with certainty. Fed policy, Chinese demand, geopolitical developments, technological substitution, recycling rates, mine supply responses. But the mechanism underneath is now visible. And once you see the mechanism, you stop asking, what will the price be? You start asking different questions. How much short interest remains? What happens if volatility forces leveraged participants to reduce positions? At what price does recycling supply overwhelm the deficit? How long can industrial buyers absorb these input costs? These aren't predictions, they're pressure points. History doesn't repeat events, it repeats incentives. In 1980, silver reached $49.45 per ounce during the Hunt Brothers squeeze, a combination of concentrated positioning, physical demand, and monetary instability. The rally ended when margin requirements increased, leverage unwound, and the participants who had driven prices higher were forced to sell. In 2011, silver reached $48.70 during a global monetary expansion and sovereign debt crisis. The rally ended when the Fed signaled it would taper asset purchases, reducing inflation expectations and strengthening the dollar. In both cases, prices didn't collapse because the fundamentals were false. They collapsed because the positioning had become unstable. Prices are the headline. Plumbing is the story. Do the math with me. If commercial short interest stands at 4.4 billion ounces, and if those positions are hedges against future production, then as long as mine supply continues, the shorts can theoretically be maintained indefinitely. But if those positions are speculative, or if they're leveraged, or if they're held by entities with limited capital reserves, then any sharp price move creates immediate pressure to cover. And covering at $94 when you're short from $70 means locking in a 34% loss. That loss is acceptable if it's small relative to your capital base. It's catastrophic if it's not. We don't know the distribution of those positions. We don't know the risk tolerance of every participant. We don't know which entities are hedging and which are speculating. But we know the mechanism. Late cycle markets reward positioning over forecasting. The participants who survive aren't necessarily the ones who predicted correctly. They're the ones who sized their exposure appropriately, maintained flexibility, and avoided forced liquidations. Complacency looks like confidence. Awareness looks like caution. They're easy to confuse until the mechanism engages. 2 takeaways. First, about systems. Markets don't break because they're irrational. They break because rational decisions, made individually, create collective fragility. Every hedge made sense. Every supply deficit was real. Every price increase was justified by documented demand. But when enough participants position the same way, even rational behavior becomes unstable. The system doesn't need to be wrong to be fragile. It just needs to be crowded. Second, about human behavior. Late cycle rallies feel different from early cycle rallies. In 2020, when silver was $18, buying felt contrarian. In 2026, when silver is $94, buying feels validated. But validation is not the same as safety. The participants who do best in volatile markets aren't the ones who feel most confident. They're the ones who maintain enough doubt to stay flexible. Confidence closes options. Doubt preserves them. Silver will continue to trade. The price will move. Some participants will profit, others will lose. But the mechanism, tightening plumbing, rising prices, structural positioning, feedback loops, will remain. Because the mechanism isn't about silver, it's about how markets work when flexibility disappears. If this helped you see the system more clearly, consider liking the video and subscribing, not for predictions, but for perspective. Because the next time you see a market moving fast, you'll know what to look for. Not the price, the plumbing underneath it.